Investors are growing increasingly convinced that the Fed may be done raising interest rates. Interest rate traders today are seeing only an 8.6% chance of a 25 basis point hike in November. And you can see how that number has come down dramatically over the past month. It comes as wholesale prices for the month of September came in hotter than expected. And we're also getting a read on consumer inflation tomorrow, of course, with CPI. Joining us now is Reese Williams, Spouting Rock Asset Management Chief Strategist. Reese, it's especially interesting that we got the minutes from the Fed's last meeting. They dropped today. They seem to indicate another increase, but, that's from a few weeks ago now, and it seems like the perception has really changed here. So are we done? No more interest rate increases?
Well, my guess is tomorrow's CPI number is going to be pretty decent as well. So I just don't think they're going to have the ammunition to raise the rates in November. And so, yes, I believe we've probably done. And I think most of the federal governors speaking this week have kind of suggested that could be the case as well, given the backup in bond yields.
And Reese, the Fed's one issue, of course, and we've been talking today with different experts about the new geopolitical risk as well in the Middle East. I'm interested, Reese, how you're thinking about that crisis, that war. Market right now seems to think it's going to stay contained, but is that impacting your asset allocation in any way?
Well, I think it's a risk to the market that this does expand. It somehow Iran gets driven in. We've known for years that Netanyahu has not been a big fan of Iran, has not wanted Iran to be a nuclear power. This could be the excuse, to do something about that. On the other hand, he's got his hands pretty full in Gaza, and he's trying to run a coalition government. So I think in the short term, that and the fact that the Biden administration has clearly gone out of its way to indicate that Iran was not part of this attack, or at least was not behind it, would suggest that that's probably off the table in the short term. In the longer term, though, I think it's going to be harder for Saudi Arabia to cut a deal with Israel, and in return for this American arms package that they've been hoped for, and obviously the quid pro quo on that might be that they increase oil production in an election year for the Biden administration. So that was one thing that was sort of hovering over the oil markets, which might be favorable, I guess, for oil prices over the next 6 to 12 months, as Saudi probably doesn't help out Biden in his next year's election.
And so put all this together for stocks for us, Reese, because when you look at the bond yields now, coming back down a little bit, that is, seems to have been provided a little bit of relief for stocks. Is that kind of, do we have sort of a bullish setup here going into year's end?
I believe we do. And I think the stock market has been maniacally focused on interest rates. And, that's what caused the September swoon in the second half of the year. And I think the fact that bond yields have improved over the last couple of days, that's really helped the market. So I do think it's not about profits. It's more about interest rates, and the idea that if interest rates are up and to the right for forever, which is sort of how the market was feeling at the end of September, that's going to be your friend when that stops. And I do think that that's the case. And that's why I'm pretty enthusiastic about a fourth quarter rally, assuming nothing goes terribly wrong in the Middle East.
Reese, if a fourth
it's also
quarter
a seasonally
rally could
very
be
strong period.
If that fourth quarter rally is in the cards, who do you think leads it? What companies, what sectors do you think would carry it?
Well, the safest bet is to continue with the big cap tech trade. I know they're expensive, but the earnings are probably going to be fine there. They have a lot of cash. They're benefiting from the high interest rates with their money market interest, and therefore I think that's the safest bet. Also, if I'm wrong and the market goes back down, they'll probably outperform. And if you want a little bit of beta, you can suggest some of these really beaten up groups like REITs that have been pretty bond proxy sensitive, and I think that might be an attractive area because they have just been hammered this year. They got hammered last year as well, and so if people feel a little bit better about interest rates, those REITs that are exposed to some real estate that is not office, basically, that has underlying good dynamics, might be a good place for alpha in the fourth quarter.
And Reese, all of this said, we're also coming up on earnings season. Is that going to give another positive catalyst to stocks?
Well, I think it's going to be mixed. I mean, look what's happened with healthcare. There really hasn't been any bad earnings. And yet every stock that has something to do with weight loss or the possible effects of the weight loss drugs has just been destroyed in the last month. So I think that's another area completely unloved, completely beaten up. I wouldn't not buy today because every time there's a piece of good news about Eli Lilly or Novo Nordisk drug, these stocks get destroyed. But as I was talking to one analyst this morning, these stocks are the healthcare space in general is sort of back to 2009 valuation levels. So it's almost like the last 10 years never happened. So I do think that's an area that's attractive, and not everybody is going to go on a weight loss drug. Look what's happened to these packaged food stocks. I think we've had an example now of Constellation Brands said beer sales were great. Pepsi Cola said people are still eating potato chips. And so that's another area that stocks have been weak because people are worried that people are not going to eat those kind of foods anymore. And I think Americans like to eat salt and like to eat fat, and that's probably not going to change anytime soon.